It's recording now. So we are hyper focused in on Florida, and you'll see some of the reasons why in this presentation as to why we are focused in Florida. And so you could ride on the coattails of a lot of the research and networking that we have done there. Or, is there a market that you're most interested in living in the future? There's a lot of snowbirds that are in Canada, and, where do they go to in the wintertime to escape the cold? Well, maybe that's a location that you actually wanted to explore. So, or you could choose one of the top growing markets. So I want everybody on the call to kind of throw out and throw it in the chat here, maybe some of the markets that you want to focus in on. Whether it's Fort Collins, I see, somewhere in Texas, out in the middle of nowhere, just throw out some locations and markets, and we're gonna dive into each one of these. I want everybody to participate here. So we got Salt Lake, Houston. What else? Colorado Springs and Fort Myers, Fort McMurray. Unfortunately, I'm not going to cover Fort McMurray today. Jacksonville, Manhattan. Okay. Cleveland, Tampa. All right. Nashville. Okay. These are all good. So as we're going to go through this, let's see, go on to the next slide here. We're going to break it down into basically 6 essential factors, what I call the essential factors. So the number one thing is population growth. I already kind of covered that. Where is population migrating to and from? You obviously want population growth. As population grows, there's more demand. It drives up real estate prices. We're also going to talk about the median household income growth, median house and condo value, rent growth, change in crime, and job growth. So again, these are the 6 essential factors for selecting a market. So let's dive into it. Essential factor number 1, population growth. So we want to look for markets where the population is ideally between 250,000 and 1 million in population. And now the reason I say that is because when you're under 1 million, you're kind of setting yourself outside of the primary markets. And I'm going to get into that, what a primary and secondary market is later on. But choosing a market that is 250 to 1 million people, and look at the city population, not the MSA. So like an MSA is the metro statistical area of a certain location. So for example, I'm from Denver, Colorado originally. And Denver's huge MSA, but it includes a lot of surrounding areas. But the city of Denver is actually quite small in comparison to the overall area. So we want to look at sites like Google or CityData.com, and I'm going to put some of these links in the chat box for you guys so that you can reference these real quick. But I want everybody to pull up CityData.com. And enter in the city that they were thrown out there. Unfortunately, this is only going to work for markets that are in the U.S. Chilliwack, for example, Anna is not going to be on there. So I'm only focusing in on the U.S. this time. But we want to select markets that are growing at least 1% per year over the last 5 to 10 year period. So here's an example. And I'm going to use Tampa as my case study throughout this whole presentation. And there's reasons why we're using Tampa. There's also reasons why we are so hyper-focused in on Tampa. And you'll see a lot of those reasons why during this presentation. So Tampa, if you go into Google, just Google population of Tampa, and this is what will pop up. You'll actually get a nice colored graph that shows what the current population is in 2021. And you could scroll back to 2011. So over that 10-year period, if you do simple math, 387 divided by 307 minus 1 is 0.25. So that's 25% growth over the last 10 years, which is about 2.5% per year. So now that you guys have selected your different markets, please throw out, like, what are you seeing as far as the growth over the 10 years? Before I move on to the next step. And what I want to do is I actually want to add these to this market selection spreadsheet so that everybody on here can kind of see how each market is slightly different from the other. So hopefully you guys are participating in the little exercise here, but do select the market in CityData. Tell me what the population growth is over the last 10 years. I'll give it a second for you guys to work on that. Okay, Orlando, we got an increase of 1.93%. Okay. Anybody else? As you guys do that, I'm going to keep going. Okay. We got just a limited time here and a lot of slides to cover, so don't want to be sitting here waiting for all these to populate. But keep doing this exercise as we're going through here. Wow, we got Fort Myers 91.3% in the last. Is that the last 10 years? Yeah, incredible. Calla 39%. Nice. Very good. Okay, we'll carry on. So you can do that exercise on Google just to see what the growth is, but there are other references that you can research. So Axios, sorry, is a website that provides some of this data in nice colored graphs and charts for you. But you could see the change in population in Florida versus the change in population in Texas. So the areas that are dark green are the areas that are 5% increase over the last 2 years. You can see Tampa here. It's basically just over 1% per year. And the surrounding area around it, so like Sarasota, Fort Myers, and Naples, those are dark green. And then you got the area between Tampa and Orlando, so up through Gainesville, up towards Tallahassee. You've got a large population growth that's happening in there. But let's look at Dallas. Dallas is, there's no change in population basically in the center of Dallas. And then you got Fort Worth that's to the left here, but everything around it is growing. So that's just interesting to see. So you could actually start selecting markets around Dallas that have a 5% population growth year over year. Houston as well. There's a growth around Houston, growth around Austin. And then there's people that are moving away from the border as well. So you could research a lot of this information. Go to Axios.com and find these cool little maps for you. So essential factor number 2, median household income. So we want to look for markets where the median household income growth between 2000 and 2021 is over 35% or more. So how did I get to 35%? 35% is basically the statistical average for showing a growing market based on lots of different research that we've done and different reports. And so you want to have at least a 1%, 1.6% per year growth in income. So again, use CityData for this. And you could scroll down to the median household income. And here's Tampa, for example. So you can see in Tampa in 2000, the median household income was $34,000. And today, 2021 is $63,000. And the reason that it's not 2023 is because in order to get more updated information, you have to pay subscriptions to certain services like CoStar, RealPage, places like that. But these are free sites for you to use that you can kind of see what the growth is happening up to basically 2021, sometimes 2022. So in this example, 2021, 63,000. In 2000, it was 34,000. So again, simple math. it shows you that there's been 84% growth over the last 11 years or so. So do that exercise with the markets that you've selected, and just put in the chat box here what you're seeing for median household income growth. Wow, population change in Fort Collins, Colorado since 2000 is 42%. Wow. Okay, so we're going to carry on. All right, the essential factor number 3, median house and condo value. Again, we want to look where the median home value is also growing, right? Between 2000 and 2021, you want to see at least 50%. That is just showing you that there's appreciation, there's value being created in these markets. Of course, there's inflation that's a part of that too, but you want to make sure that the growing house is also an indication of market appreciation. So with 50% or more between these periods, it's about 2.3% per year. Again, this is all statistical information based on some of the top markets and what is good indicators for looking at. So you can still find this information just below the median household income under CityData.com. And so you can see here for Tampa, the median house or condo value in 2021 is $336,000 when it was $80,000 in the year 2000. That's a 317% growth over the 11 years. So that's incredible to think about, like that value that's growing over that period of time. So why is this also important? And I'm not going to get into too much detail on this presentation, but there is a growing gap between affordability of the affordability of houses for first-time buyers, for the median price of home versus the household income. So that gap is growing. This map that you see here on the right, this is just a map based on where renters do or do not meet the income requirements for a starter home mortgage. And really the only places that they've identified in green is Tulsa, Oklahoma, and Oklahoma City, Detroit, and this looks like maybe Memphis, Tennessee. But that's you could find this information on Axios as well. But that gap is growing, and so as you look into these markets, you want to make sure that that the housing expenses, like if your household income with a higher mortgage, I just lost my train of thought on that. But breaking down the household expenses shouldn't exceed your 30% of gross income. Obviously, with higher mortgage rates, that housing costs keep climbing and climbing, and home ownership is getting more out of reach for first-time buyers. So that just means that there's going to be more renters in the market. So you also want to compare that household income, rent affordability versus rent growth. So when you're looking at apartments, and say you were a tenant that was applying for an apartment, they qualify you based on your household income, and your average rent. How they do that is they figure out what the average rent is times 3 times 12 months, and that must meet your minimum household income. So let's break it down. Tampa again. So the average effective rent for a B-class property in Tampa, and this is all of Tampa, $1,760. According to the Marcus and Millie Chat multifamily report. So the minimum annual income needed for that rental, $1,760 times 3 times 12 equals $63,000. Well, the median annual income is $63,000. So you're right there. And so why is this important? It's because when you're looking at like a value add opportunity, for example, you don't want to be the nicest property on the block. You want to buy a property that has been underperforming, where the market rents are below average, and checking your minimum annual income needed for that area, so that you're not going over that 3 times average rent income. So essential factor number 4, rent growth. So rent growth is also a very critical metric in assessing the market's attractiveness for real estate. So rent growth indicates that there's a market stability, there's potential for more income generation, and it's influenced by the balance between housing supply and tenant demand. So Marcus and Millichap puts out these great reports every year and also every quarter. John Chang, who was actually on one of our webinar series a few weeks back, he's an author in these reports. And so, these are very detailed reports. You could actually download them for each of the markets across the US. But you can see here, and I'm going to get into more detail about this spike later on. But you can see that the year-over-year percentage in rent growth is above 0. So there was a huge spike in rent, but it leveled back down, and this happened because of COVID and also some other factors which I'll get into. But you can see that the rent growth is projected to be basically about just under 4% for 2023 in their forecast. Within that same report, they put together all the metros and were able to identify the metros that had the total change in rent from 2019 to 2023. And Tampa here is on the far right. That could be a good thing and a bad thing. And you can see here in the subject line, having the sharpest come down. But I'm a believer in why Tampa is still positioned in a way that it's going to see continual rent growth that I'll get into it in a few moments. But you can see the list here that the markets that had the slowest growth since 2019, you got San Francisco and New York, San Jose and Oakland. And over here on the right, you've got some of the metros that had the fastest growth. So you got Tampa, Fort Lauderdale, Jacksonville, Tucson, Miami. So a lot of Florida locations here in Orlando. But then you got Arizona, Tucson and Phoenix, Charlotte and North Carolina. All right, so hopefully everybody's keeping up with me, and as far as like the markets that they pre-selected in the beginning of this presentation, and kind of following along and seeing that the market that they selected and how it's kind of fitting within these essential factors. So now we're going to get into crime. So how does crime relate to what we're looking at? Well, obviously crime levels change over time, and there are bad cities that do well over time, that gentrification happens, new policies, new development, new attractions. And so that does change over time. So, but crime is actually an inverse relationship to education. So if you look at markets that have, lots of universities, white collar jobs, and where you have basically a very educated center, statistically, you'll see that the crime is actually lower. So this is probably one of the better ways to find if you've got a well-educated market. So you want to go to CityData.com and you look for markets where the crime index is below 450 and that it's trending down over the years. So let me take a quick stop and actually show you for Tampa on CityData.com. So this is the crime rate index that CityData.com puts together. There's a lot of numbers in here, but basically it scores the location based on the type of crime, so murders, rapes, robberies, and so on, it does look like a lot of red. But the thing that's important to really note is where was it at and where is it going? And so you could see Tampa back in 2007, it was quite high, but then it's been trending down over time. There's a bit of a blip here, but that's a natural occurrence that happens within every market. But what you want to see, and you can see the U.S. average is 254. So that's all of the United States. And so you can see here in Tampa, it's been trending down. So it was in 2010, it was 347, and now it's 212. And I don't want me to be picking on Baltimore here, but and if anybody's in Baltimore, forgive me. But you can see here their crime index is actually quite high. So in 2010, it was 691, and it's grown to 909 in 2020. So do look at that. Throw it in the chat box and where the markets that you are currently looking at. Just let me know what the crime index is in those different markets. All right. Chat. Here we go. Okay. All right. So the final essential factor is job growth. So ideally, we want to look for markets that have about a 2 to 3% annual growth over the last 12 months. So before we were looking at the history over the last 10 years, we're going to look at a little bit more current, which is the last 12 months. So the best website that I found for this is the Bureau of Labor and Statistics website. There's also other websites that offer this type of information. Like the Department of Numbers is also another good reference. But in the Bureau of Labor and Statistics, this is a little bit more accurate. And they show here the over the year percentage change. So over the last 12 months, and I've sorted this by the largest number to the least. And you can see that Las Vegas is at the top of the list with 4.5%. Dallas at 3.8, Charlotte is 3.7, Jacksonville 3.6, Tampa right here 3.2. So, and you can see how, keep scrolling down. But this is, I'm going to actually put this in the chat box for everybody so they can quickly reference this. Salt Lake City, crime index was 663 in 2020. Interesting. Okay. So again, we want to focus on the last 12 months. And in that table that I showed you here, it's the year over the year percentage change. Marcus and Millichap's multifamily report has also collected a lot of this data. And when they put together this report, it was at the beginning of 2023. So they probably didn't have all the numbers at the time for 2022. So they have a little asterisk here as to estimated levels of job growth and their prediction for 2023. And you can see that it's actually quite low. So maybe that's an indication of a recession. Not exactly sure. So, but you can see here, I sorted everything to from the largest numbers down for 2022. You got Miami, Charlotte, Houston, Dallas, Raleigh, and Nashville that are at the top of the list. And then you've got Tampa down here at number 15 with a 4% growth. So again, going back to what you're looking for, ideally, you want to be looking for something that's been growing 2 to 3% annualized over the last 12 months. And you can see here that at least the top 20 here are growing over that recommended amount. So also tied with job growth is you want to make sure that there's diversity. So there are locations across the US that are heavy in military or heavy in government. And so you want to make sure that there's no single employer that has over 20% of the market share. This is a report from Yardi and also the Bureau of Labor Statistics that shows the employment sector for Tampa. And you can see here that transportation, trade, and utilities is close to 20% of the market share, but that's not the single employer either. So it's very well diverse, at least in Tampa. But you can actually download these reports if you go to Yardi. They've got excellent reports for all the different markets and across the U.S. So if you wanted to find out a little bit more how your market is doing, I recommend checking out Yardi. And you also want to look for Fortune 500 companies, other top employers. One of the top employers that I'm actually missing here from the Tampa market is Amazon. But aside from that, you've got a lot of strong companies that are in Tampa. So do look for Fortune 500 companies when you're selecting your markets. So again, we're going to cover we already covered the essential factors, which was population growth, the median household income growth, the median house and condo value, the rent growth, change in crime, and job growth. So based on that and some of the information, and if you guys are following along, and I see lots of comments that are coming in here about the different markets that they selected. But what are your top market predictions based on some of the information that I shared here? Go ahead and throw that in the chat. Tampa, Texas, Vegas. Okay. Houston. Stay away from boom bust markets. Yes. So you want something that's steady growth. And boom bust being like South Dakota, depending on petroleum. Baltimore. Yes, stay away from Baltimore. Orlando. Yes. All right, good. Keep them coming in. So again, within that Marcus and Millichap multifamily report, they've done a lot of this research of what I just covered. And so they've made your job easy, basically. So they've come up with a national index that ranks the 50 major markets based on projected growth, job growth, vacancy, and construction. Construction is also leading to absorption, vacancy, and occupancy, which I'm going to get into here shortly. Housing affordability, rents, price appreciation, and cap rate trends. So you can see here that Jacksonville was one of the locations that were thrown out there. Got Vegas that's on the list, Denver at 19. And then we've got Tampa at number 5, and at the top of Fort Lauderdale. Dallas, Fort Worth. Dallas has always been strong and a good market, but there's a lot of submarkets that are around Dallas. So other considerations, supply and demand. So what do I mean by this? So these are two graphs that show similar stories, but tell different stories a little bit. But so you've got, this is the deliveries, absorption, and effective rent change that's on the right. This came from RealPage. Carl Whitaker, another guest that we've had on these webinar series, he's the director of research and analysis at RealPage. And so this is their graph that shows the deliveries, absorption, and effective rent change. So what do I mean by deliveries? Deliveries are brand new developments and apartment buildings. So and you want to see what the rates, the rate at which new properties are being leased and sold, and how they affect the real estate landscape. So in here, you could see that obviously in 2020 was a big year for many reasons. But there was a dip in vacancy from this graph that's here on the left, and this is from CoStar. Both of these are for Tampa, by the way. And so you can see that there was a dip in vacancy in Tampa. And with this dip in vacancy, there was a spike in effective rent change. So where there was more demand, there was obviously a higher change in effective rate. But also something else to pay attention to is the number of deliveries or the properties that are being developed and how they're being absorbed. So back when interest rates were very cheap, there was many developers that came in and saw that there was a need for a demand for more properties in Tampa, and it went gangbusters. There's actually a record-breaking number of deliveries that are hitting the market in Tampa right now. But my prediction is that because of the rising interest rates, a lot of these developers are going to be in hot water, and there's going to be a significant drop in deliveries. And with that significant drop in deliveries, again, you're going to have more of a demand because there's population that is growing in Tampa. And so you can see here, CoStar's prediction, at least for the deliveries or the properties that are being developed, it has a drop off. And of course, the absorption follows along with it. Vacancy kind of goes up because there's more supply to the market. But then I think a lot of these are going to taper off really quick because of the interest rates. And then what RealPage is actually predicting is there's going to be a nice steady growth of rent over the next 4 years. When we analyze deals, we actually look over a 5-year horizon. And so over the next 5 years, 2028 from now, I think we're going to be in a great spot based on some of the trends that I see here from the deliveries and absorption and the effective rent growth. So I think this line is actually, my prediction is actually this line is going to go up a little higher. But we're conservative in our underwriting that we are only right now predicting a rent growth of maybe 1.5 over the next year. So other considerations, you want to make sure that the state is also landlord friendly. So here from Law District, they put together their top 10 landlord friendly states. However, they got it wrong. They highlighted Arkansas and where they should have highlighted Arizona. So Arizona being right here. But anyways, so the map is wrong, but everything else is right. And in fact, August put together a blog a while back, which I'll share the link with you guys here. And his top 10 landlord friendly states to invest in. So I'm going to share this with everybody in the chat. And so you could always come to our website for lots of articles and blogs based on the information that we're sharing with you today. So what is a landlord-friendly state? That there's no rent control, that there's low property taxes, no or favorable security deposits, and a speedy eviction process. You don't want your tenants sitting there not paying rent, where you can put somebody that's is paying rent and increase your NOI. So other considerations, you want to make sure that the state or the local community is a job and tax friendly state. Property taxes is becoming a big thing in many states where they're being reassessed at a higher assessed value and growing really quickly. Florida, for example, has a cap where you cannot be reassessed. If you own the property, you can't be reassessed more than 10% every year. Some other states, there is no cap. And then insurance costs insurance costs have gone gangbusters across many different markets, including Florida and Texas, where it will cost you, $2,000 a unit in Florida versus say $800 a unit in Alabama, or $500 a unit in Colorado. So insurance costs have been driving the expenses up in many different markets. So not every market is perfect, but as long as you underwrite to the correct value in insurance costs and consulting with your insurance carriers, you're doing the best you can to at least protect your property and your investment. So again, look for states that have natural disasters such as flooding or wildfires or windstorms. And the carriers are increasing their emphasis on property valuations, and even some of the carriers are hitting their capacity. They've set limits on which markets they are going to insure. And so they have basically like an annual quota, and if they hit that quota before the end of the year, well, if you're underwriting a property and you're trying to close on it before the end of the year, you need to check with that carrier because they have their capacity that they've cut off. And of course, you've got rising cost of material, labor, and services that are also impacting insurance costs. So it's not just the hot markets like Florida and Texas, but we're actually starting to see these trends increasing in the other markets. So do pay attention to that. There are lots of research reports that are out there that we collect our information from. And we actually put together a weekly newsletter that summarizes many of these reports. So I do recommend that you go to our website and subscribe to the newsletter that we have. But some of the best reports that are out there is the Marcus & Millichap U.S. Multifamily report. Marcus & Millichap also puts together very specific market reports. So like for Tampa and Jacksonville, Orlando. And you've got Yardi, which is also another great reference. And then your brokers that are in these markets. So CBRE and Berkadia, they also produce these great reports for specific areas and what they're and where they're working. And these guys know best, right? They know the market. They see the trends. They know what's coming. They're talking to all the sellers and all the buyers. So they're in the mix. And so these guys are really your best friends in those markets. So get to know them, get to know the brokers in each of those markets, subscribe to their websites and newsletters as well. But also do take a look at our weekly newsletter. Again, there's lots of articles that are out there. Just go ahead and just start Googling your market that you're interested in. Look for, best multifamily markets to invest in for 2023. Bigger Pockets is a good reference to look at. U.S. News, Bloomberg. I already referenced U-Haul before, and RealPage. RealPage is a great source for information on trends and what's happening with just general analysis of different markets. All right, I'm almost done here. But I'm gonna finish it off with talking a little bit about primary, secondary, and tertiary markets and submarkets. So we covered a lot of information today, and we started big and started narrowing down to different states and different markets. But want to highlight the differences between primary, secondary, tertiary, and a submarket. So you're going to have to keep breaking these down, these areas, until you have identified basically the market that you want to focus in on and why. So primary market, these are the largest, robust MSAs in all of the country. You've got secondary markets. They're very solid with, the economic fundamentals and growth. And they're just a little bit smaller than your primary markets. And then you got tertiary markets like smaller towns and cities, the flyover zone, if you want to say that. And so, but they have very unique types of investments. And I'm going to get into that here in a second. And then you've got submarkets. A submarket is a smaller, more localized segment of each of these areas. So primary markets. So the advantages of a primary market is there's strong job growth. There's a higher rental demand. You got favorable lending, excuse me, favorable lending for debt. But it comes with a lot of challenges. You got high property prices, you got very intense competition, and you've got lower cap rates. And so the investment strategy for primary markets is low risk that are in prime locations, and it's more of income preservation. So a lot of these institutional type of companies are going into these primary markets and buying these A-class properties. And so they're getting consistent rental income. And these are cities that are, they don't shut down. And they're always going to be there. So it's low risk for them. So what is a primary market? Basically, you got New York, LA, Chicago, San Francisco, DC, Dallas, Fort Worth, Houston, and Atlanta. So a primary market, it's not just defined on its population. It's also defined as far as the overall economy. So I'll give you a good example. So you got New York, obviously huge population, and then you've got Denver. Denver is actually considered a primary market. In the total MSA, there's a little over 2 million people in that market. But Denver is the largest city within a 500-mile radius. So, there's nothing else around it. So it becomes a primary market based on its economics. So it's not just about population. So we got secondary markets. The advantages of secondary markets is you got a lower acquisition costs compared to primary markets. You have less competition, you have growth potential, and you've got higher cap rates. So some of the challenges, maybe a little bit more volatility, and a little bit of volatility in the rent growth and job growth. But as long as you're investing for the right reasons, for growth and affordability, you've got lots of value add opportunities. You got a diverse tenant pool, and you can entail that with just a little bit of moderate risk. So Tampa is a secondary market. It has a growing healthcare sector. It's a thriving business environment, lower cost of living compared to Miami. Jacksonville, it's actually Florida's largest city. It's got a very diverse economy with strengths in logistics and financial services, manufacturing. And then you got Charlotte, which is also another strong secondary market, known for its job opportunities and affordable housing. So now we're getting into tertiary markets. So the advantages of tertiary markets, you got really high yields, you got lower acquisition costs, and less regulation for development or unique type of opportunities. Challenges, you got limited tenant pools, lower liquidity, it's harder to get lending on, potentially higher risk. But this is where you can capitalize on potentially higher yields and profiting in the long run, because you got affordability, you got also niche markets and property types. So this is where you can actually work on development projects, build to rent communities. That's a popular thing that's been popping up around Florida, Texas, and the Sunbelt states. And you need a large area to kind of sprawl out to build these places. And they are attractive. So the tertiary market is perfect for that. And then you also got self-storage, that is also a good asset class for tertiary markets. So what is a tertiary market? You got Gainesville, but you got the University of Florida, and it's a very stable economy. It's centered around education and healthcare. Birmingham, Alabama, is a great tertiary market. Diverse economy. You got strengths in finance and healthcare and manufacturing. And then Macon, Georgia. So it's got rich history and diverse economy, and a great location for investments. So I'm going to dive a little bit into submarket and submarket selections. Basically every market there exists a submarket. So within the primary, secondary, and tertiary markets, you've got defined borders that are either neighborhoods or districts, very specific regions within the market, and they have very unique characteristics as well. that you've got different schools, different development trends, housing preferences. So you got like downtown areas versus more of the suburban sprawl kind of feeling. And I've got Tampa shown it here from CoStar, and there's basically 13 submarkets. So each of those submarkets are different with and around Tampa. They all have different market rents. They have different growth projections. There are markets in Jacksonville and Tampa that we're kind of staying away from now because there is certain areas where they're predicting lower rent growth. So again, you can narrow everything down and try to get it down to basically a 3 to 5 mile radius of what areas you're going to be looking at. I didn't have a slide for this, but a good example is when you look at Jacksonville. And a broker told me this right when we first started looking into Jacksonville, and he said, just basically like look at Jacksonville like a clock. There's a ring road around Jacksonville, and you've got the river, the St. Johns River, that runs north and south. And so that divides the clock. So anything that's basically from 3 to 6, that's your best submarket. And then the other submarkets rank decreasingly from that location. So brokers are some of your best references when you're trying to find out which areas you want to look at. They know the areas that are growing, the gentrification that's happening, these different trends, different development projects, which areas have better schools. And you got to look at all the demand drivers, which are changing the economics between each of the markets. And look for other signs of development and infrastructure growth, like highways and bridges. Is the city growing that it needs to meet that demand, and put in more infrastructure? Are there big box stores like Target or Walmart or even Starbucks that are moving into these areas? So talk with your broker, explore these markets, and really help narrow down what you're trying to do. And a lot of this takes a lot of time to do this, and we've spent months understanding each one of our markets. We've gone to the markets and we've dove into it. We've met with the brokers. We've walked the properties. We've explored the cities just to see what's really going on. I'm putting up here a list of other additional resources that you could check out. So a lot of these names I've already mentioned, like RealPage and CoStar, Crexy, CityData.com. Bestplaces.net. You could look for the crime rates and the cost of living. Justice Map is another website that we use. Neighborhood Scout. It's really good for crime rates, looking at the general demographics and school ratings. Neighborhood Scout is a paid subscription, but you get the most up-to-date information. Greatschools.org is a really good place to look for like school ratings, and then Axios and U-Haul. And of course, our weekly newsletter, where we take a lot of these articles, filter out a lot of the noise and kind of concentrate it down into simple summaries for you. So with that being said, I really am thankful for everybody's time here today, and everybody's participation. I hope you guys learned a little bit about growing markets. But if you have a deal that you want to share with us in Florida or other growing markets, please email us at deals@cpicapital.ca. Or like if you don't want to do all that work, and if you wouldn't just invest with us or partner with us, if you have opportunities that you think that you want to share with us, please just give us a call and book a call at the website here, which Seth kindly added to the chat box. So with that, I'll leave it to questions and answers. And Seth, anything else?
Yeah, Paul, that was an excellent workshop. That was great. I'm sure everybody here is busy taking notes. That was awesome. Thank you very much. We do have a bunch of questions that came in. So Paul, if it's cool with you, I'll read them out and we'll go through them. And okay. So just a quick reminder, if you do have questions, put it down in the chat box. We'll make sure we go through everything for you. Okay, so first one, Aaron's wondering, will the slides be shared at the end of the presentation? Yeah, no, Aaron, generally we'll, like these are done live. but we are working on something where we can have like a storage of everything that we do. So stay tuned on that. Marcos, just made an offer on a multifamily in Alabama. Can you pull up anything on that market? I think that was back when you were going through all the different markets. Do we have anything for Sweet Home, Alabama?
Sweet Home, Alabama. I could pull up some information, yeah, on Alabama just to kind of take a look. Let me pull up some information here then. But yeah, if you want to keep going to the other questions, and I'll share some
Sure.
thoughts here.
Sure. So Adam has a two-parter here. So he says, as you've shown, Florida has been growing rapidly for years now. Isn't there a saturation point where the market starts to turn down, and it isn't a great place to invest anymore? How close are we to that time? So maybe can you touch on the 4 stages of the market cycle and how that impacts everything?
Yeah. So right now we're in hypersupply, which I showed an example of what's going on in Tampa. There's a hypersupply going on right now. There's a lot of development, which is going to lead into a recession. So we're seeing it right now. There's been a huge drop in sales and volume. In Jacksonville, there's been over an 80% drop in sales volume this year alone compared to the previous years. And that's a sign of rising interest rates, sellers not wanting to sell. They're only selling if they need to sell. So a lot of the current sellers are holding on to ride out till what's the term? Survive till 25. So you could look at it from like, okay, what's going to happen in the next year? We look at a couple of factors when we underwrite. We look at one, cash flow. We invest for cash flow. So, if there was, a recession or any type of drop in the economy somehow in these different markets, as long as we are cash flowing and can meet our debt service coverage ratios and our overall vacancies, we'll end up being okay. And we'll ride out the storm. So if there is a storm that's coming, after hypersupply, there's a recession. And so we might be going into that recession right now, just based on what we're seeing in the couple markets that we're in. With what, just make sure that I did answer everything that he asked here. Did I miss?
Yeah.
Oh, did I?
Yeah, so going into the third part, so that covered the first part. Adam then was saying Tampa's a big city. We showed the average rent medium income for the city. How do we narrow that down to the 3-mile radius within the property? Like maybe like the CoStar reports and all that kind of stuff.
Yeah, great question. Let me just pull up a CoStar report for a specific property. Give me 1 minute and I can show you. So CoStar is great at providing you real-time data on, especially on a specific property that you might be looking at. So 1 second, I will pull up a property.
Yeah, we'll have to start earning commissions for when people buy the CoStar service.
Yeah, exactly.
All right, cool. While you pull that up, I'll just pop down to Karen's next question here. So are there any articles of any updates that new companies or businesses planning to open in a recent market? So Karen, I think you mean like new businesses coming to a market. Yeah, there's for the larger employers, like they'll publish a press release. So like look for Amazon opening up a new distribution center. They're going to publish a press release there. A major company, shifting. So for those major employers, 100%, there's going to be publicity and PR. In terms of smaller businesses, I always suggest you contact the business development department. Every city has a different name for it, or even the Chamber of Commerce, and they should be able to provide you some good statistics for that specific city, for new businesses opening, any data they have, because there are literally people whose only job it is to compile these numbers for you. So that the trick is just finding the right person. But if you call the city, many major cities have investment departments there to help attract people.
Perfect. So I do have a CoStar report here as an example.
We'll have to share your screen again.
Sure. Here we go. Can you see it now?
Yep.
So this is an example of a property in Jacksonville that we've been looking at. And this just shows the demographics within a 1, 3, and 5 mile radius. So you can see what the population was in 2022, what the forecast is for 2027. So the population growth in a 1 mile radius. You got your household income, median home value. So everything that I just talked about, the essential factors are all right here, basically on this page within a 1 to 5 mile radius for this specific property.
Yeah, that's awesome. Thanks, Paul. And then okay, so and then Adam again. So Adam, 3 for 3 here. Is there a data source you can use to see where Target, Walmart, Starbucks are moving? That's a good one.
I don't know.
Yeah, I would think Google Maps. If you just open up Google Maps and search Starbucks, I don't know of a specific list where it has all the upcoming markets, because usually that's, you know, proprietary information, I would say. I don't know, Paul. Do you know anything?
My best guess is to again, go to the planning and development for each of the cities or counties. Ask them if there's like any applications or ongoing developments of certain commercial properties like Starbucks. They might be able to help you. Brokers would probably be your second resource that I would recommend reaching out to. They're a wealth of knowledge. They know what's being developed in those areas. I was thinking that there might be another resource that you could look up, but I mean,
No.
Google's my best friend, so I would start messing around on Google and finding out what pops up.
Yeah, for sure. And typically, when you see a new strip plaza being developed, you can kind of tell what's going in there already by the style of the building. So oftentimes you'll see the major banks, like you can tell which bank's going in there just by the way they're building it out. So yeah, like drive by the strip mall, see there's probably a for lease sign in one of the buildings, call up the broker and they probably can tell you who else is moving in for it in terms of an anchor tenant. Guillermo, he's asking about our address. Yeah, so Guillermo, I am based in Toronto. Paul, August, and Ava, they're based in the States. So we've got both sides of North America covered in terms of Canada and the US. So so if you have questions specific, but yeah, we can help you out no matter which country you're in. Monil is saying, there is a website that shows all the upcoming Starbucks. That's pretty cool. My fiance would appreciate that because she drinks Starbucks all the time. Awesome. Cool. I think we covered all the questions. That was really good. So I'll just do a last call for questions there. But yeah, if you are on right now and you're interested in possibly becoming a co-GP, passively investing with us, just go to go.cpicapital.ca/call. Okay, so we've got Lee or Leah is asking any market resource suggestions for Canada.
So CoStar does exist in Canada. Unfortunately, CoStar is a paid subscription. And I'll have to check with RealPage if RealPage offers any information on Canada.
Yeah, and a great resource for that is you'll see Marcus and Millichap reports.
Yep.
CBRE, Colliers, all the major brokerages are going to be publishing these reports for Canada as well. So we have people on another program who invest in Canada and the US, and all the major brokerage reports will have great information. So everything Paul talked about tonight is available for Canada too. It's just going to be a slightly different resource that you'll use.
Yeah.
Okay. And somebody's saying, I'll buy you coffee for every CoStar report. So that's awesome.
Okay.
Yeah.
Perfect.
So maybe we'll just do one more question here, Paul. JP's wondering, thoughts on investing long distance or out of state?
Well, I'm doing that. For me, because I have is a good example. So like, so I grew up in Denver, but I currently live in Victoria, but we're investing in Florida. So that's opposite ends of the continent, right? And so, but the important thing is having relationships there. So our CIO and CEO are actually in Florida. They recently moved down there. One of the reasons they moved there is because they wanted to actually be close to this market and understand the market. But if you are going to invest in long distance or out of state, I recommend that you have somebody in that market that you know, like, and trust. You got to be able to go to these properties, within 2 to 4 hours notice, and being able to secret shop the property, dropping in on the property manager. It's really important to have somebody that's pretty local to that area or can get to that area really quickly. Or you could partner with other investors that are already in that market that know what's going on. Like us, we have our relationships and contacts that are in Florida that I refer to and I trust down there that can get us this information and be my eyes if I can't make it there in a 4-hour notice. So that's my thoughts.
Yeah, no, that's great. Very last question for the night. Anonymous is asking, can foreigners invest in the US? How is the international tax treaty applied? That's going to depend on the country that you're coming from. For instance, Canadians can easily invest in the US. With CPI, we're basically built to efficiently move Canadian dollars across the border because not a lot of US operators understand the cross-border implications with Canadians, and that's something we deal with every single day. So we're specifically structured for our Canadian investors to invest in the most efficient way in our US deals. But if you're coming in from other countries, you're going to want to speak with a cross-border accountant who understands that specific treaty, because the rules will be different depending on what was negotiated between the two countries. So Canada and the US, talk to us, book a call with us, and we're happy to fill you in. But anything more international, speak with a specialist in that respect. Awesome. Paul Hopkins, thank you very much. You crushed it.
Thank you. Yeah, thank you. And thanks everybody that participated in the chat. Yeah, looking forward to the next time.
That's great. So book a call at go.cpicapital.ca/call. And other than that, somebody says nice beard. So Paul, that's great. And until next time, happy investing, everyone. See you soon.
Thank you.